Did you know that venture secondaries are now 20% of the secondaries market? Okay. And it is actually one of the fastest growing segments within private equity. Venture secondaries also have a long history. The first venture secondaries transaction took place in 1979 when a gentleman called Dayton Carr acquired LP interest from IBM, from various venture funds, and the same guy put it into the first venture secondaries fund in 1982. So this is an asset class with 45 years of history, right? But we're not going to speak about the past. We're going to speak about where are we now? What's going on now? So Fiona, let's start. Maybe give a brief introduction, who you are, what you do, what's your link to the theme.
Oh, wow. Okay, so lovely to be here. And I think all of you can agree that it's been a phenomenal day. So well done to all the organizers for pulling this together. So my name is Fiona. I joke about it, but I seriously have been about 25 years in private equity and venture capital. I started off as a fund-of-fund investor on behalf of a very large corporate. I then was part of a VC fund for many, many years. And then a year ago, I decided to cross the lines. I have seen every type of transaction you can imagine. I'm actually based out of Israel, but navigate between Israel, London, and New York. But I've seen everything from LP interest, direct secondaries in startups. I've done investments in startups. I've taken companies public. I've seen key people events in funds. I've just seen everything in the industry. And about a year ago, literally having been a venture capitalist for so many years, I thought it made a lot of sense in this current climate, this current time, we'll touch on this in the panel, to cross the lines and to do venture secondaries, essentially giving access to tech and venture, but with a slightly more structured and financial mindset.
Thank you. Jörg?
Yeah, Jörg Goschin, it's a pleasure to be here, and also my great thanks to the organizers and for you, for the audience to listen to us, the last panel between us and the cocktails. So I'm running KfW Capital. KfW is the world's largest development bank. I've set up for KfW a subsidiary, KfW Capital. We are investing in European venture, in the asset class European venture. Last year we have raised a 1 billion fund of fund with institutional investors, mainly insurance companies, pension funds, large single-family offices from Germany and also from abroad, investing into this fund of fund, and this fund of fund is co-investing with our strategies in the area of European venture. To say it up front, we haven't done any secondaries yet. I have some secondary experience from our past, and I'm working together with the German government to create a secondary market because we think it's a very important function which is lacking in the market, but we'll touch upon this later. Overall, we manage about 14 billion on our own balance sheet and also on fiduciary mandates in the asset class European venture. And we are continuing to grow. We have a team of 80 people at KfW Capital, and we are hiring as we are adding more asset classes under our management.
Let's maybe stay here with you, Jörg. Why are you getting engaged with venture secondaries? Why is it important, and why apparently is it becoming even more important?
Well, I mean, looking at a market, and our mission is, the mission of KfW Capital is to further develop the venture capital market, not for itself, but we really want to foster innovation and technology and technological development in Germany and in Europe. It's very important that you don't only have a functioning primary market. You need to create liquidity in the market, liquidity meaning also to have a secondary market. And we see a lot of investors which are not investing in the asset class because they don't get out. The holding time of a venture fund, usually a venture fund has a lifetime of 10 years and there are extensions. So there are many venture funds which exist for 12, 13, 14 years. And this is quite a long time. This is an unforeseeable future for many investors like family offices. And actually it's also, if you compare it to private life, I always say it's longer than the average span of a marriage in Germany, which is shorter. And so I think it's very important to have a secondary market to give the investors also an opportunity to dispose their assets, because this will then make it easier for them to get in. So this is one major reason. The other major reason is, we all know that we are lacking exits in the market, and many investors do not invest into the funds because they have no distributions from the current investments. And so if we had functioning secondary markets, I think we would have much more distributions and much more cash flow on the investor side, which would then also create more investments in the primary market.
Fiona.
Wow. So exactly as Jörg said, it's an unbelievable time, because we've all enjoyed watching venture capital grow and evolve into such a huge market. There's $1 trillion today of net asset value in venture capital funds around the world. It's massive, the size of that market. You know, all the innovation, you're holding your phones, we're talking today about ChatGPT, all of that came from venture funding. One of the things that's happened over the years, though, is that as the funds have ballooned, as the innovation has grown, it's taking longer. As was just said, if about, 4 decades ago, it took Apple 4 years from inception to IPO, it took Palantir 17 years. So when you want to achieve those levels of return, you can't have it in that 10+3 cycle of a venture capital fund. And it's really become a very, very legitimate complementary investment category. I mean, I don't know how many of you, but when venture secondaries started, it was the second-hand pawn shop at the end of the street. It was like you wanted to sell off your position because either you didn't have the money, you didn't have the patience, you didn't have the stamina, you didn't have the time, you didn't have the conviction. Today, it's an absolutely rapidly growing complement. Secondaries last year was over $120 billion worldwide. And it's forecast, 112 billion, and this year it's forecast to be over 130. And what it's actually becoming is an additional pool of capital that is coming in and, let's just say, buying in to existing portfolios, companies, and more, serving as a liquidity tool. So if you're driving a train, you're 10 years on, you've seen about 1 times your money back, and you want to see a bit more, you're prepared to compromise a bit of your upside, which is the main reason that secondary is on the rise. Now, venture secondaries is a whole different animal, because you saw the world of secondaries, which is, the most common secondaries is the stock market, but you had secondaries in buyout, in private equity, but in venture it's a lot more specialized, because you actually need, it's not enough to buy a bag and to decide, what kind of discount. You actually need to know what the assets are about. And that is why it's become such a very, very interesting market. And many people like myself, who are former venture capitalists, are crossing the lines, because it's a way to get a ready baked portfolio and to price it. And as said, there's many different reasons why people want to sell. They want to sell, or a fund wants cash. An investor wants cash because there's no exit. You know that there's an estimate of, I'd say that since 2018, people who made commitments from 2018 till today are out of pocket because there's not been any material exits. Again, go back to the length of the cycles, because funds are holding on to the assets longer. So you've got many different reasons that people want to cash out, but most interestingly is the majority of them, it's not for distress. It's simple things like taking a bit of money off the table. We've all gambled at one point in our lives. It can be because we need a little bit of liquidity. It can be because having the money drawn from us when we've got money in deposits that are making 6 or 5 or 6% in the bank or in the real estate market, it's too expensive to cash out there in order to meet a commitment. It can be a change of strategy, and we're seeing a huge cycle now of the big corporates, all the big brand names in the world that have built up VC portfolios around the hype of 2018, 19, and 20. They're now looking to just take it off my hands. So we're in a very, very interesting part of the cycle, and the thing that's driving it all is that it's become more institutionalized, structured, and if done right, can also make a lot of money. That was long.
Yeah, you mentioned a very important point, right? Companies stay private for much longer than before. Let's just stay there for 1 or 2 minutes. Why is that? Not only do companies stay private for much longer, we see also public companies taking private again, right? Boatloads of them, right? So explain to us, what's going on in the markets?
Well, by the way, staying private for longer, I'm going to just quickly open brackets and just say there is no IPO, there hasn't been an IPO market for the last 3 years since mid-2022, which has forced a lot of companies to stay private longer, which has created a really nasty liquidity crunch for many of the funds in the world or the investors who really want, we're a machine that's based on the exit assumption. And when there's no IPO market, the money doesn't flow back. But going back to, and we'll touch on that in a minute, but going to the IPO market, in the old days, you would, as soon as you could, you'd go public because you wanted to sell and give your money back and come back. But with the appetite and with so much more money going into this machine, returns were getting really, really high. I mean, look at the velocity of the valuations. Look where the market went in 2020, 2021. So as the value goes up, the appetite to keep going. By the way, that's the first time you bump into secondaries. Because as a company is continuing to be pushed towards that mega IPO, you also need to keep the management team motivated. How do you do that? You do secondary transactions into their stock so they see a bit of cash. So everything is keeping the machine going longer. Why? Because the assumption is that in that time, the performance will continue, the valuation will increase, and the market will recognize that. And people are getting really excited. Another trend, and then I'll stop on this, that's happening is you're seeing a lot of non-traditional investors flowing into the markets. There's ridiculous amounts of money coming in. I mean, a household name now is Tiger Global. It's a former hedge fund group. So they also came into the category. We saw, as the public markets were not performing as highly, so many groups were going a little bit earlier in the food chain. And so coming into the private assets just before they go public, all those crossover funds. So there's been a lot of dynamics that have been by all these pools of capital looking to achieve higher returns. Again, lower interest environments, people wanted to beat the market.
Anything to add, Jörg?
Yes.
Well, yes, I think there's a very important element to add. What's really also a characteristic of the venture capital market, besides the illiquidity, is the massive lack of information. So we really have, and I mean, this is really a substantial difference between other private market segments and venture capital. I think the lack of information around venture capital is also something which prevents investors from engaging into the sector. I mean, if it's almost close to, if for an example, an institutional investor, an insurance company, they manage 100 millions of assets every year with a staff of like 10, 15 people across different asset classes. And they have the liquid markets with Bloomberg and all the information systems, and they have the more mature private market segments with a lot of research information. And turning to venture, it's the potential investment amounts are tiny, and there's not even information which manager to invest in, which fund is fundraising, what's the past performance. And I think we really need to come into a situation where large investors open up their databases so that you could slice and dice the portfolio, those large portfolios, according to vintages, according to regions, according to industries, and in order to get an idea of how venture, or also stages, how venture is performing across the various sectors. There's a European association, Invest Europe. Every year they have a conference, and they invite large asset managers from the US, and they open their books and they compare the performance of US venture, Asian venture, and European venture. And interestingly, this message isn't much conveyed, but interestingly, European venture has outperformed US venture over the last decade. And this is shown by household names like Adam Street, Harbourvest, so JP Morgan Asset Management, which manage assets around the globe worldwide. And this message is consistently delivered under Chatham House rules on every conference, but I think this message needs to be spread in order to attract more investors into that asset class. And once this message gets out, I think also the secondary market will spark, because this naturally raises the attention of investors. And one comment to the presenter before from Prequin. I mean, the very last slide he showed, where he compared the asset classes. It's the venture capital asset class which has the highest performance estimate for the future, and it also had the highest, second highest performance over the past. So this was quite interesting to see, and I think we need more information in the sector.
You saw me standing up because I want to see, are there any questions in the room for our panelists? Yes, here in the back, Stephen.
Oh, that's like the $1 million question, actually, or $1 billion to be precise in our category. It's interesting. So, venture it's slightly tackled differently than buyout and PE. So it's less about buying the bag and seeing what it weighs and saying, okay, let's just chop 50% off and go with it. It's actually the way you tackle it with venture, and I'll answer your question after I warm up. The way that you tackle venture is you actually bottom up it will come multiples. So a really nasty question I'm going to give you is that the multiple on revenues, when you're valuing a company today, what's its real value, is between 6 to 7 times revenues, which is ridiculously low multiples if you think that there's companies in the market with unicorn valuations that have comps that have multiples of 20, 30, 40 times. So that can already give you a feeling for the discounts. And so you start up and you build it bottom up. Now, the report that came out in January that I urge you to read from Jefferies that talks about the secondaries market, they actually gave some interesting statistics. They talked about the discounts across the different asset classes. They talked about the discounts in venture being around the 30% mark, but I'm going to put a big asterisk on that in a minute. And the closer that the more mature the portfolio and the closer it is to exit, then you actually see the discounts narrowing, because theoretically the companies are more mature. Where are you seeing these super harsh discounts that everyone's talking about when you look at portfolios from 2020, 2021, that for no logical reason whatsoever beyond hype and demand, the companies were valued at $1 billion or 10 billion, and that the manager has chosen, for his own reasons of logic, to not mark them down. So now when we come in and we want to buy that portfolio, we're going to take a much more structured approach. Structured approach can start off from discounts. So you're absolutely right, it'll be between 40 to 50%. Or you can see different approaches, which is, okay, I'll give you more of a discount today, but after I see a performance beyond a certain level, I'll share the upside with you. So the beauty of secondaries is that you actually have this very structured mindset where you can compensate from the let's just say, protecting your downside today because nobody really knows what the number's going to be, all the way to, okay, if it hits that hurdle and that hurdle, I'll give you, and I've seen models where people have been given a profit split of the higher hurdle of over 70%. So you've got very, very nice structures. What's good about secondaries is it's not one size fits all, and it very much splits between people who want cash up front to people who want more cash up front and they're prepared to compromise their upside. So I hope that answers the question.
More questions from the audience? Yes, this gentleman here. Do you want the microphone?
Minimum and average portfolio sizes for a secondary transaction, and what are the average and maximum exit event durations for a typical?
Can you just repeat the last part of it?
The exit times.
Multiple, the multiple, okay. So can I answer?
Yeah, sure.
Okay. No. So I'm going to put, again, venture secondaries is slightly different from the mainstream secondaries, right? So you want, as a manager, you want to buy a portfolio. It's about having diversity. There are secondaries where you're buying that single couple of shares in a single asset. This is about a portfolio. Now, I've seen continuation vehicles, which is one subcategory. You can have a single asset continuation vehicle. You can have a multi-asset continuation vehicle. It's all about the strength of that asset that's going to carry the value and the conviction of the upside. Often you'll see that people's sweet spot is around between 4 to 6 as a minimum, and you'll look for at least 2 anchors. You're not going to bet all your eggs, everything on 2, on less than that. In terms of size of portfolios, I've seen portfolios. I know of a transaction with 90 pieces that went a year ago, and I specifically was offered something with over 100 recently. So it's a spread at the end of the day. Multiples. When you speak to venture capital secondaries, you'll usually see that on the minimum they're looking to achieve 1.8 to 2x net to you. And they're usually aiming to be at the top of 3, maybe 3.5. But the trick is they're trying to do it in a short time frame because you're coming in with so much theoretic visibility, you're trying to have an in and out within 4 or 5 years.
There was a question from the gentleman here in front.
Let's try to use the microphones. Who has a question? More questions? No? Yeah, this gentleman. Microphone, wait, the microphone is coming.
Thank you. In these transactions, I'm trying to picture as a buyer how you would go about doing it. The reason I ask that is every one of these deals has a highly negotiated documentation. You have information rights and this kind of right and that kind of right. How does a purchaser actually go through the documentation, and how long would you expect that to take in a, let's just say, average size portfolio? Thank you.
I think okay. I think that very much depends on the how familiar the purchaser is with. I mean, if we're talking about portfolios, about limited partnership agreements and the documentation of funds. So I think there is no. The purchaser also, and how familiar the purchaser is with the underlying assets. I think this could be, this could vary from at least a month to 3 months or even 6 months, also depending on how much negotiation is going on with the seller. But you're completely right. It's a non-standard, individually negotiated transaction, which has a lot of hurdles and loops you have to go through in order to come to a deal.
So just to add on that, it's complicated, which is why it's not something that everyone does, because you need access to the information, you need access to the people. You oftentimes have to start off stage 1 with very soft knowledge, usually relationships, people on the ground that can give you that. And after you've actually given a soft bid, then you move to the next stage, and then you dig deeper. And then you have an interesting question. There's many structures, as Jörg said, there's many structures in order to guarantee the continuum of the holding of the assets, which is super important. Also, the companies want that. And secondly, you don't want to affect the original asset. You're putting your bets on a racing horse. So you need to make sure you have all the information. And there's two ways to tackle it. One is to share with the company that a transaction is happening above, or to do the transaction and gather soft information. But you are precisely on mark. It's super complicated, and it's very, very delicate, and structures are in place to make it happen, but it's something that you need to go with someone who's done it. Otherwise, you can really get caught up having missed something, and then it's a problem because it's the private world.
Right, so we got two minutes left. And now let's stay here. I want to hear your recommendations for investors, because we have seen how relevant, how systemically relevant the development of a functioning secondaries venture market is. Everybody benefits, the companies, investors, VCs, PEs. So what do you recommend investors looking at venture secondaries?
I think, and this also relates to the last question, I think it's very important if you're entering the secondary market, first to start somewhere, ideally with a smaller portfolio, and at least as important is to do it together with someone who has experience in that area, because it's really, as we said, it's a highly structured market. In order to jumpstart the secondary investment activity, I think players like the EIF in Luxembourg, which is in Europe the largest investor in the European venture asset class, or even KfW Capital or BPI in France, or British Patient Capital here in London, those are players who manage already existing portfolios of venture capital fund investments. They get every quarter the quarterly reports from those funds, and for players who have an existing portfolio, they know their assets, they know the underlying portfolios. I think this would be easy, or they would be in an easier position to price transactions as they come up. So this could also be a starting point to look what those firms are invested in. But start with something rather small and do it together with someone who has experience.
So I'm just going to quickly, because I'm conscious of time. It's still a big novelty. It's very new. It's super structured. It's really not straightforward because, again, the information rights is probably the biggest hurdle, but also the legal structures. I say it's, as a starting point, partner with someone. Don't even try. Partner with someone to do the first deal. Follow a manager. One of the interesting things is this is the darling of individuals and family office investors, this asset class, because it's smaller check sizes, and you get a lot of ability to follow and watch it through, and you have a bit of fun along the way because it's a little bit closer to watch, and enjoy the journey the first time round. And then later on you can move to the bigger players, but start small, see how it is. It's different. It looks the same, but it's different. But again, it's supposed to be shorter term. It is shorter term. It works really well if you do it right. And I urge you all to give it a shot, because I'm enjoying this journey like crazy, and I think you all will. Hopefully we'll all meet here in a year's time, and I'll have a lot more to share.
Wonderful, great. So that's a great final word. Thank you, my dear panelists.